Dorothy retired at 67, 41 years as a school administrator in Ohio. She had $490,000 sitting in her 403b, a pension of $880 a month, and $1,340 a month in Social Security. Her financial advisor told her not to worry about taxes anymore. Dorothy, he said, with the new 2026 senior deduction, your tax bill is basically zero, so she believed him. Then a letter arrived from Medicare. Dorothy was now being charged an extra $594 a month, what the IRS calls an IRMAA surcharge, on top of her normal Medicare Part B and Part D premiums. That surcharge cost her $7,128 every single year, and the income that triggered it happened 2 years earlier, before she even knew IRMAA existed. The $4,700 deduction her advisor celebrated? It didn't touch her Medicare bill by 1 penny. Nobody told her that. Dorothy is not unusual. She is exactly what happens when retirees with traditional IRAs and modest fixed income do not understand the Medicare trap hidden inside the 2026 tax law. If you are 62 or older, have money in a traditional IRA or 401k, and you plan to take this new deduction, you are in the crosshairs. Not the wealthy investor, not the person with a massive pension. You. That IRMAA surcharge can cost you anywhere from $2,000 to more than $12,000 every single year. Locked in by income from 2 years ago, a year you probably already lived through. Today I'm going to show you exactly what the $47,500 deduction is, who actually qualifies, and the 5 Medicare traps that will drain that benefit before you ever see a dollar of it. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Frank Dalton. I spent 35 years as a CPA working with retirees before I stepped back from the practice. Every week on this channel, I break down the tax rules, the IRS traps, and the strategies that protect retirees from the things your advisor never mentioned. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Let me get into it. Number 5. What the $47,500 deduction actually is. Let me start with the number itself, because most people are already confused about it. For 2026, the IRS has finalized an updated deduction structure that, for the first time, stacks 3 separate tax benefits on top of each other for seniors. Here is what that looks like in plain numbers. First, you have the standard deduction for a married couple filing jointly in 2026. That comes in at approximately $3,800 after the inflation adjustment. Second, the IRS provides an additional standard deduction for each spouse who is 65 or older in 2026. That is $1,600 per person, so $3,200 for a couple where both spouses qualify. Third, and this is the new piece your advisor may not have caught yet, the expanded senior deduction provision adds up to $13,500 on top of that for qualifying married filers, both age 65 or older, within specific income limits. Stack all 3 together. $30,800 plus $3,200 plus $13,500, that is $47,500 in total deductions before you have touched a single itemized expense. For a married couple, both over 65, within the qualifying income range, that is the number. Now here is what your advisor probably told you. This means more of your income is sheltered. And technically, that is correct. If you are in the 22% tax bracket, $47,500 in deductions is worth roughly $10,450 in actual tax savings. That is real money. Here is what your advisor probably did not tell you. Medicare doesn't care about your deductions at all. Let me put a dollar amount on this so you understand what I mean. Take Robert and Sandra in Arizona. Both are 68. Their gross income is $95,000 a year. Social Security, IRA withdrawals, a small pension. After the $47,500 deduction, their taxable income is $47,500. Their federal tax bill is modest. They feel good. But Medicare looks at their modified adjusted gross income, their MAGI, which is $95,000. That puts them squarely inside the first IRMAA surcharge bracket. They are paying an extra $594 per month in Medicare premiums they did not budget for. That is $7,128 a year. Over a 20-year retirement, that is $142,560, and it comes off the top of a deduction they thought was protecting them. That is the first thing you need to understand. The $47,500 helps your income tax. It does not help your Medicare bill. And in many cases, the strategies people use to claim it will make their Medicare bill worse. I'll come back to exactly how in a moment. Number 4. The IRMAA 2-year look back that is already affecting you. Here's the part that should bother you. IRMAA, the income-related monthly adjustment amount, is the Medicare premium surcharge that hits when your income crosses certain thresholds. In 2026, the first threshold for a married couple is $212,000. For a single filer, it is $106,000. But here is where the trap is. Medicare does not look at what you earned this year to set your premium. Medicare looks at your tax return from 2 years ago. Right now, in 2026, Medicare is using your 2024 income to determine your 2026 premiums. Think about what that means. The year you retired, the year you rolled over a 401k, the year you took a large IRA withdrawal to pay off your mortgage, the year you did a Roth conversion that pushed your income up. That year, 2024, is the year that sets your Medicare cost right now in 2026. And there is nothing you can do about 2024 income in 2026. That window is closed. Take Patricia in Florida. She retired in 2024 at 66. Before she left, she cashed out a portion of her 401k, $85,000, to pay off her house. Smart move emotionally, expensive move on paper. Her 2024 MAGI came in at $147,000. She thought that was a one-time event. It was for taxes. But for Medicare, it put her in an IRMAA bracket that she is still paying for in 2026. Her Medicare premium surcharge is $396.90 per month. She had no idea that withdrawal, which she made before she even knew what IRMAA was, would follow her for 2 full years. Let me put a dollar amount on this so you understand the stakes. Patricia is 66, retired, living on $52,000 a year in income. Her base Medicare cost is roughly $2,090 a year. With the IRMAA surcharge triggered by her 2024 income, she is paying an extra $4,762 a year in Medicare premiums for income she no longer earns. Over the 2 years that 2024 income affects her, that is $9,524 in extra Medicare costs from a single decision she made in a single month. That is not a tax bill. That is a penalty for not knowing the rules before you acted. Here is what most retirees don't know. You can appeal an IRMAA surcharge if you had a qualifying life event: retirement, divorce, death of a spouse, loss of income. The IRS form is SSA 44. It is free, it is a few pages, and most retirees who qualify never file it because nobody told them it exists. I'll circle back to this before the end of the video. Number 3. How Social Security taxation quietly devours your deduction. Now, before I get to the next one, I need to address something people get completely backwards. The $47,500 deduction gets you excited because you think your taxable income is dropping to near zero. But that calculation ignores the Social Security taxation formula. And that formula does not work the way most people think. Here is the rule. Up to 85% of your Social Security benefit is taxable if your combined income, that is your adjusted gross income, plus any tax-exempt interest plus half of your Social Security benefit exceeds $44,000 for a married couple. That threshold has not been inflation adjusted since 1984. The IRS has never moved it. As a result, over 50% of Social Security recipients now pay tax on their benefits, including millions who retired thinking they would not. Here is the problem with the $47,500 deduction. It reduces your taxable income after the Social Security formula has already run. The formula uses your AGI before the standard deduction is applied. So even if the $47,500 deduction brings your final taxable income to near zero, the IRS has already calculated how much of your Social Security is taxable, using a number that the deduction never touched. Take George in Tennessee. He is 70. He receives $26,400 a year in Social Security and takes $36,000 from his traditional IRA. His combined income for the Social Security formula is $36,000 plus $13,200. That is half of his Social Security, which equals $49,200. That pushes him above the $44,000 threshold. Up to 85% of his Social Security, $22,440, is now taxable income. The $47,500 deduction reduces what he owes at the end, but it does not reduce how much of that $22,440 entered the taxable column in the first place. Let me put a dollar amount on this so you understand the stakes. George is in the 22% bracket on his last dollars of income. That $22,440 in taxable Social Security costs him $4,937 in federal income tax on income he already paid into the system for decades. The $47,500 deduction offsets some of it, yes, but the deduction is doing cleanup on a mess the formula already created. The smarter move is to not create the mess, and I will show you exactly how before this video ends. Number 2, the RMD collision that pushes you into the trap. Here is the one most people miss entirely. If you are 73 or older, you are taking required minimum distributions from your traditional IRA or 401k. You do not have a choice. The IRS mandates it, and every dollar of that RMD hits your MAGI, the number that Medicare uses to set your premiums. This is where the $47,500 deduction creates a false sense of security that becomes genuinely dangerous. Here is how it plays out. A retired couple takes their $47,500 deduction, sees their taxable income drop, and decides, logically it seems, to do a large Roth conversion while their taxable income appears low. Or they take a large IRA withdrawal to fund home repairs or help a child. Their taxable income after the deduction still looks manageable on the income tax side, but their MAGI, the Medicare number, NAS, has spiked. And 2 years later, Medicare sends them a letter. They are now in an IRMAA bracket they never planned for. The Roth conversion that looked smart on paper created a Medicare surcharge they will pay for the next 2 years. Take Charles and Elaine in Georgia. Both are 74. Their RMDs total $48,000 a year combined. They saw the $47,500 deduction and decided this was the perfect year to do a $50,000 Roth conversion on top of their RMDs. After the deduction, their federal income tax bill was manageable, but their MAGI jumped to $143,000. In 2026, that puts them in the second IRMAA tier. Their combined Medicare surcharge is $791.40 per month. Let me put a dollar amount on this so you understand the stakes. Charles and Elaine are paying $9,496 per year in IRMAA surcharges for 2 years, because the 2026 income will also affect 2028 premiums. That is $18,209.90 in extra Medicare costs from a single Roth conversion decision. The Roth conversion itself may eventually pay off, but they needed to see both sides of the ledger before they acted. Most retirees only see one side. Their advisor only showed them one side. Number 1, the deduction phase out that nobody reads in the fine print. And then there is the biggest one. The $47,500 figure, the full amount, is not available to everyone. The enhanced senior deduction component phases out. It begins reducing at $75,000 in modified adjusted gross income for single filers and $150,000 for married couples filing jointly. It phases out completely, meaning you lose the $13,500 enhanced piece entirely, at $175,000 for single filers and $250,000 for married couples. That means if you have pension income, Social Security, RMDs, and any additional income, rental income, a part-time consulting arrangement, dividends, you may be celebrating a $47,500 deduction that you do not actually qualify for at the full amount. Here is the part that should bother you. Most tax software will catch this. Most CPAs will catch this. But most financial advisors, the people who are telling their clients the new 2026 deduction is going to save you a fortune, are not running the phase-out calculation before they have that conversation. They are quoting you the headline number. They are not quoting you your number. Take Helen in North Carolina. She is 68, widowed, files single. She has a pension of $22,000, Social Security of $18,000, and IRA withdrawals of $40,000. Her MAGI is $80,000, above the $75,000 phase-out start. The enhanced $13,500 portion of the senior deduction begins reducing immediately. By the time the phase-out calculation runs, she qualifies for roughly $9,800 of the enhanced piece, not $13,500. Her actual total deduction is around $43,300, not $47,500. The gap is $4,200. At her 22% bracket, that is $924 in taxes she did not expect. Let me put a dollar amount on this so you understand the stakes. Helen is 68. If she lives to 88, that is 20 years of retirement. If she never corrects her income planning strategy and runs into this phase-out every single year, she overpays roughly $924 annually on just this one issue. Over 20 years, that is $18,480 in taxes she did not have to pay if she had understood the actual rule. The $47,500 number is real, but it is the ceiling, not the floor, and most people are operating somewhere below it. Let me give you a real example of how this plays out. Take Bill and Carol. Both are 71. Bill receives $22,800 a year in Social Security. Carol receives $14,400. Their combined RMDs total $42,000. They have no pension, no rental income, just those three sources. Total household income, $79,200. In the scenario where they do nothing and take the full $47,500 deduction, why, their taxable income is $31,700 after accounting for the Social Security formula. Their federal income tax bill is approximately $3,500 for the year. That sounds good. But their MAGI is $79,200. That is well below the IRMAA threshold. Their Medicare premiums are standard. So far, no trap. Now here is where it goes wrong. Their financial advisor recommends a $60,000 Roth conversion this year because their taxable income looks low. Their MAGI is now $139,200, still under the first IRMAA threshold of $212,000 for a married couple. No surcharge yet. The conversion adds $13,200 in federal taxes. Total tax cost this year, roughly $16,700. The Roth grows tax-free. That can be a reasonable trade. But now suppose their RMDs increase next year, which they will, as the IRS recalculates annually. Their base income rises to $88,000 before any conversion. If they do another Roth conversion, even a modest $30,000, their MAGI hits $118,000. That is still under the married IRMAA threshold. But if one spouse passes, the surviving spouse files single. The IRMAA threshold for a single filer drops to $106,000. Now, $118,000 in income triggers the first IRMAA surcharge, $2,376 per year in extra Medicare premiums, because of conversions they made when they were married, using math that no longer applies to their filing status. That is $4,752 in extra Medicare costs over the 2-year look-back window from a decision they made in a completely different tax situation. That does not mean Roth conversions are wrong for Bill and Carol. If they have adult children who will inherit a large IRA, a Roth conversion is still an excellent long-term move. But if they are making those conversions purely because the standard deduction makes the current year tax cost look low, they need to see what happens to their MAGI, what happens if one of them dies, and what their Medicare bill looks like 2 years from now before they sign anything. Let me bring it all together. Here are all 5 in order. Once the $47,500 deduction is 3 separate deductions stacked together, and it reduces your income tax, not your Medicare premium. Know what it actually covers before you celebrate it. 2. IRMAA uses your income from 2 years ago. The decisions you made in 2024 are already setting your 2026 Medicare premiums. If you had a high-income year at retirement, file Form SSA 44 to appeal the surcharge if you had a qualifying life event. It is free, and most people who qualify never do it. 3. Social Security taxation runs on its own formula that the standard deduction does not fix. Up to 85% of your benefit can be taxable based on combined income, and no deduction changes that calculation. 4. RMDs and Roth conversions done in the same year can spike your MAGI past the IRMAA threshold, even if your income tax bill still looks manageable. Always run the MAGI number separately before deciding. 5D, the enhanced senior deduction phases out starting at $150,000 MAGI for married couples and $75,000 for single filers. If you are above those numbers, you are not getting the full $47,500. Run the actual number, not the headline number. 5 things the IRS built into this system. All of them matter. Most retirees know 0 of them on the day they start claiming the deduction, and every single one you miss costs you real money. This is Frank Dalton. If this video helped you, hit the like button right now. It takes 1 second and it helps this video reach more retirees who need to hear it. If you're not subscribed yet, hit subscribe and turn on the bell so you don't miss the next one. The video I'm working on next breaks down the exact IRMAA appeal process, Form SSA 44, when to file it, what qualifies, and what to say, because that one video could put thousands of dollars back in your pocket if you retired in the last 2 years. You need to see it before your next Medicare premium notice arrives. And if you know someone who just retired or who is planning a Roth conversion this year without understanding the Medicare side of it, send them this video today, not tomorrow, today. Because Medicare uses this year's income to set premiums in 2028. That window is still open right now. It will not be. Drop a comment below and tell me this. Do you know what your MAGI was in 2024? The number Medicare is using to set your premiums right now in 2026? I read every single one, and the most common situations become future videos. I'll see you in the next one.